The median home in America now costs $412,000. Not in San Francisco, not in New York City, the national median, the middle of the entire country as of 2024. That number is 5 times the median household income. The ratio economists have traditionally used as the threshold for affordability is 3. The current ratio is 5 and still rising. To afford the monthly payment on that median-priced home, a buyer needs to earn at least $126,000 a year. Among the nation's 46 million renters, only 6 million can meet that threshold. The expectation that lower mortgage rates will fix this has not held up. Rates are at their highest level in more than 15 years, and home prices have continued to set records regardless. The S&P CoreLogic Case-Shiller National Home Price Index confirmed new all-time highs in April 2025. A structural problem is keeping inventory suppressed. Nearly 48% of homeowners with a Fannie Mae or Freddie Mac-backed mortgage locked in a rate of 3.5% or lower. Moving to a different home at current rates on a $300,000 loan would add roughly $580 to a monthly payment. Most of those homeowners are not selling, which means inventory stays low and prices have no downward pressure. The Atlanta Fed's Housing Ownership Affordability Monitor reported in mid-2025 that owning a median-priced home consumes 47.7% of the median household's income. That figure has held between 40 and 50% for 2 consecutive years. The conventional benchmark for affordability is 30%. The national median has been more than 50% above that threshold for 2 years running. According to the National Association of Home Builders, 76.4 million households, 57% of all U.S. households, cannot afford a $300,000 home. That figure sits below the national median. A majority of American households cannot afford a home priced below the national median. On the rental side, 43.5 million households were cost-burdened in 2024, spending more than 30% of their income on housing costs. Within that group, 21.6 million were severely cost-burdened, spending more than half their income on housing costs alone. The National Low-Income Housing Coalition estimates a national shortage of 7.2 million affordable rental homes. For every 100 extremely low-income renter households, 35 affordable units exist. The shortage traces to a construction collapse that began in 2008. Before the financial crisis, developers were starting over 2 million housing units per year. By 2009, that number had fallen to 554,000, and recovery has been incomplete. In 2004, 186,000 new single-family homes were under 1,400 square feet, the starter home category. In 2023, that number was 87,000, half as many starter homes in a market with far more demand for them. Researchers at the Brookings Institution documented in spring 2025 that Sunbelt cities, Atlanta, Phoenix, Dallas, Miami, which historically served as lower-cost alternatives to coastal markets, are losing that distinction. Economist Joseph Yorko noted that if that trend continues, it will be the first time in American history without affordable housing markets that also have high job growth. Food prices have followed a separate but consistent pattern. Since December 2019, the cost of food has risen 29.5%, outpacing overall inflation, which rose 23.9% over the same period. Prices compound on prior years rather than reversing. The cumulative effect since 2019 is nearly 30%, regardless of how much the annual rate has slowed. Egg prices illustrate how supply shocks embed themselves in that trend. Retail egg prices rose 32.2% in 2022, 8.5% in 2024, and 21.9% in 2025, driven by an ongoing bird flu outbreak that began in 2022 and had affected over 169 million birds by May 2025. Orange juice rose 28% from January 2025 through early 2026. Ground beef was up 13.7% over the same period. The average American household spent $10,169 on food in 2024, according to the Bureau of Labor Statistics. A 2024 survey from Purdue University found that consumers estimated food inflation at 5.3% that year, nearly triple the official estimate of 1.8%. The gap reflects a real distinction. The Consumer Price Index measures how fast prices are rising, not how much higher they are than 5 years ago. Consumers are carrying the accumulated weight of every prior year's increase. The rate slowing down does not make the base any cheaper. Wages have not kept pace. Since January 2021, prices have risen 22.7%, while wages have grown 21.5%, according to bank rates analysis of Bureau of Labor Statistics data. As of June 2025, 43% of American workers were still losing purchasing power in real terms. The Ludwig Institute for Shared Economic Prosperity tracks a true living cost index that weights housing, healthcare, food, childcare, and transportation more heavily than the CPI does. Since 2001, the CPI has risen 77.2%. The True Living Cost Index has risen 106%. In 2024, the cost of a basic but secure life for a family of 4 reached $121,000. Annually, median household income was approximately $77,000. That is a $44,000 gap between what a median income provides and what a secure life costs. National health expenditures reached $5.3 trillion in 2024, $15,474 per person, accounting for 18% of gross domestic product, the highest share ever recorded. 44% of U.S. adults reported difficulty affording their healthcare costs. 36% skipped or postponed needed care in the past year because of cost, including 37% of adults who have insurance. Gallup and West Health found that 29 million Americans are categorized as cost desperate, meaning they cannot afford or access needed medical care. That share rose from 8% in 2021 to 11% in 2024. More than 82 million Americans made at least one financial trade-off with daily living expenses to pay for healthcare, and an estimated $74 billion is borrowed annually in this country to cover medical costs. Childcare now costs more than rent across most of the country. The national average price of center-based childcare reached $15,570 in 2025. In 45 states and the District of Columbia, the annual cost of childcare for 2 children exceeds annual mortgage payments. In 49 states and D.C., it exceeds median annual rent. A 2025 American Family Survey found that 70% of Americans describe raising children as too expensive, up 13 points from the prior year. And for the first time in the survey's 11-year history, finances were the primary reason Americans cited for limiting family size. Bank of America Institute analysis from late 2025 found that 24% of U.S. households were spending over 95% of their income on necessities, leaving little or nothing for savings. Federal Reserve data from 2024 found that 37% of U.S. adults could not cover a $400 emergency expense. Total household debt reached $18.8 trillion in the fourth quarter of 2025. Credit card balances hit a record $1.28 trillion. The personal savings rate stood at 4.5%, roughly half the 60-year historical average. Approximately 32% of working-age Americans have no retirement savings at all. The federal minimum wage has remained at $7.25 per hour since 2009. Workers at the bottom of the income distribution have absorbed 16 years of compounding price increases on an income that has not changed in nominal terms. Jean Ludwig, chairman of the Ludwig Institute, said in February 2026 that the pace of inflation has eased, but the affordability challenge has not, that the cost of essentials continues to rise faster than wages, and that the gap between headline inflation and the real cost of living remains significant for low and middle-income Americans with little margin for error. Joe Wadford, an economist of the Bank of America Institute, put the arithmetic plainly in November 2025. If bills are increasing by $300 and income is only increasing by $100, the math does not balance. The median home buyer is 59 years old. The typical first-time buyer is 40. Home prices are 5 times income. Food costs nearly 30% more than in 2019. Healthcare is 18% of the entire economy. Childcare costs more than rent in most of the country. The federal minimum wage has not moved in 16 years. These are not projections. They are current measurements of a system in which the standard costs of living have, for a large share of the population, exceeded what their incomes can support.